Welcome back to another episode of Global Insights for Tax Leadership, your go-to video series for relevant topics impacting the tax profession. Again, whether you're a seasoned tax professional or simply someone looking to better understand the complexities of the tax world, this series is designed with you in mind. So we are now on to our third episode, and for those following along, we decided to switch topics a bit, and I'll cover that in a second as to why. But if you're enjoying the series or you're new to it, please give it a like or comment on LinkedIn and YouTube. So the reason that we shifted here a bit with this third episode is we're seeing a quantum shift in the way planning and restructuring from a state lens are impacted by current efforts around global reform and, quite frankly, into the future by future tax reform. And I thought since we covered some of the retaliatory measures as it relates to Pillar 2 on our last episode, it'd be good to shift and dive into how global tax reform, specifically Pillar 2 and some of the other regulatory and legislative matters, are impacting the world of state and local tax. And for those that don't know, I'm Jeff Burns, a lead tax partner in KPMG's business tax services practice. And today I have the pleasure of joining me, good friend and partner, Justin Hill. Justin's a partner in KPMG's Washington National Tax Practice and is also the National Strategic Services Group practice leader. Justin's based in Dallas. So Justin, thanks for joining me today.
Thanks for having me on, Jeff.
So the first place I really wanted to start is to talk about some of the impacts Pillar 2 might be having on state tax planning, restructuring, and quite frankly, just normal decision-making as it pertains to state and local tax. So Justin, maybe if you can give some background there and we'll take it from there.
Yeah, no, it sounds great. First, let's take a step back and start by connecting the dots between Pillar 2 and state tax in general, more as background information. As you know, Jeff, Pillar 2 aims to establish a global minimum corporate tax rate of 15%. So to do that, it's designed to ensure that large multinational companies pay a 15% minimum level of tax in each of the jurisdictions where they operate. So as part of that analysis, you look at effective tax rate for each jurisdiction, which is equal to the adjusted covered taxes divided by global anti-base erosion income. So as a general premise, state and local income taxes are considered covered taxes. But Jeff, as you know, with state tax matters, typically the devil is in the details. And that's particularly true here. One of the main work streams companies have been focusing on involves determining which state and local taxes are considered covered taxes for purposes of computing your jurisdictional effective tax rates. And there you're looking at the definition of covered taxes in Article 4.2 of the Pillar 2 model rules. The term's broadly defined. It includes taxes imposed on income or profits, as well as taxes on retained earnings and corporate equity. So as you can imagine, there's a lot of focus on whether certain gross receipts-based taxes or franchise taxes, for example, qualify. The computation of a state effective tax rate also involves looking at state credits that apply and looking at whether those are refundable or non-refundable. Also looking at state uncertain tax positions and reserves is important, and a host of other interesting issues, like whether you're able to attribute state and local taxes to non-U.S. entities, either through worldwide filings or perhaps water's edge groups with non-U.S. member inclusion, whether partial or full. So here it's important, out of the gate to nail down what I call your base case state tax Pillar 2 impact first, before you start looking at planning.
So Justin, you hit on some important pieces there, and I think about that in the context of making sure you're data ready and that you have your inventory and your model start to build around your state base case. It's extremely important. But as we think about once that's completed, what should tax professionals think about as they look to planning or restructuring?
Jeff, really two areas. So the first is domestic planning specifically. So as multinational companies focus on creating state and local tax efficiencies, really is a matter of course, whether through structural changes or tax return positions. It's important to consider the Pillar 2 implications. And we've seen situations where a change involving only U.S. entities or operations can provide a neutral Pillar 2 result with state and local tax savings offset through the top-up tax regime. At the same time, multinational companies are also routinely looking at their global structure and considering business-led structural or operational changes in the Pillar 2 impact. So changes to the global structure can and oftentimes do accompany unintended U.S. state and local tax consequences. And state tax reach can be a long one. If you think about economic nexus provisions, market sourcing rules that can pull in non-U.S. entities, subject them to filing. Those that can apply for corporate income and franchise taxes, but also thinking about the sales and use tax considerations. They're not likely covered taxes for Pillar 2, but can be triggered unintentionally as a result of an overall global restructuring effort.
Yeah, and I think hitting on that last point, Justin, we talk about global restructuring. Are you seeing companies think about how they might modernize their structure and leverage what I think we can agree is historically an international tax concept, and that being value chain?
Yeah, Jeff, it's a great topic, which is value chain. So without getting into significant detail, the value chain really has its roots in international tax concepts. But the primary thought process is that given the state of disruption in supply chain, IT, finance transformation, and tax, the business is informing what the structure and intercompany transactions should really look like. And tax professionals are ready to layer in, on the tax wrapper to what the business is already indicating and how it operates. So the business informing tax where enterprise value is, tax is planning and restructuring with that in mind.
So we've talked about a lot. And so I think in closing, what is the main thing that organizations should be doing right now to prepare for, what we're seeing in terms of additional change or disruption as it relates to state and local tax? And where do we think, that might be headed?
In terms of where we're headed, I think, Jeff, that state and local taxes will continue to be an important focus for companies, particularly with the Pillar 2 impact we just discussed, as well as with some recent federal legislative proposals. For example, looking back at federal tax reform, the corporate income tax rate went from 35% to 21%. And as such, state income taxes became more front and center for many companies. But now you see with recent federal legislative proposal to limit the state tax deduction for corporations, efforts to modernize structures and focus on value chain planning may be even more impactful for companies. And in terms of what companies can do now, I think creating and maintaining an effective state tax model is critical, whether that's specifically tied into the overall Pillar 2 modeling efforts or as a standalone model that can be used to be able to quickly assess enhancements and changes and be more proactive with planning efforts in order to maintain or achieve an efficient tax structure. I really think the modeling there is the key to continue to focus on that modeling effort and be ready to be proactive.
Yeah, no, I think that's a great point. If there's anything we could share with folks is be model ready, leverage technology in that analysis so that you can pivot quickly when changes happen or disruption happens in the organization. So Justin, thank you again for your time. I really appreciate it. And I want to urge everyone to look for our next video series where we will actually be discussing accounting for income taxes and some of the new related disclosures. So thanks everyone, and thank you, Justin.
Yeah, thanks, Jeff.